Right now, the market is treating a premium, cash-printing athleisure giant like it's a distressed asset that's going out of business. We're talking about Lululemon. The stock has been absolutely punished, the narrative has turned incredibly sour, and Wall Street is basically pricing in a structural collapse. But when you look beneath the headline noise, you uncover a massive tension between the market's perception and the fundamental reality.
9.2. That is Lululemon's current trailing price-to-earnings multiple. To understand just how wild that is, you have to realize that for the last decade, this stock commanded a multiple between 29 and 34 times earnings. It was priced for absolute perfection, and now it's priced for disaster. But when we act as financial detectives and actually look under the hood at the underlying machinery of this business, the facts tell a completely different story.
And this completely exposes that valuation disconnect. We're looking at a 34% return on equity, a fortress balance sheet with $1.5 billion in cash and zero long-term financial debt. This is undeniably a strong business generating a massive 7.1% free cash flow yield. It doesn't even own its manufacturing facilities, which keeps its capital expenditure requirements low and allows it to fund ongoing aggressive share buybacks. So why the punishment? To figure out what the market is missing and what it might actually be getting right, we have to understand how this economic engine actually works.
So let's break it down. For the fiscal year ending in early 2026, Lululemon generated an incredible $11.1 billion in net revenue. The absolute foundation of this business, bringing in 63% of that revenue, remains women's apparel. Think the iconic Align legging franchise and those incredibly popular Scuba Fleece hoodies. But men's apparel is a rapidly growing segment, now up to 24%, largely driven by their ABC. Anti-ball crushing pants that have become a total staple in casual office and travel wear. The final 13% comes from accessories in their expanding technical footwear line. They are surgically targeting premium-tier, affluent, active lifestyle consumers, and they do it better than almost anyone else in a global athleisure market that's projected to grow from $422 billion today to nearly $890 billion by 2033.
Now, what makes Lululemon's business model so resilient is its economic moat. They don't just sell clothes, they operate a vertical retail architecture. That means they sell directly to consumers through their own stores and digital platforms. There's zero wholesale markups eating into their profits, which is exactly how they maintain premium gross margins that still hover above 54%. Second is their material science intellectual property. They use trade secret raw fabrics like LULU and Luxtreme, partnering closely with international suppliers to create a science of feel the competitors really struggle to replicate at scale. Finally, instead of dumping money into expensive, traditional advertising, they use a hyper-local, ambassador-led community model. They partner with local yoga instructors and athletes who promote the gear organically. It creates incredible brand loyalty and a massive lifetime value for every single customer they acquire.
But if the moat is so strong, why the 9x PE? Well, on June 4th, 2026, Lululemon reported their Q1 fiscal 2026 earnings, and it revealed a stark, jarring geographic divergence. In the Americas, which accounts for 66% of their total revenue, comparable sales actually dropped by 5%. Slower store traffic, cautious consumer spending, and a predictable product assortment hit them hard at home. Yet in mainland China, comparable sales rocketed up 20%, driven by incredibly positive brand reception and new store openings. The market basically looked right past the massive international momentum and went into full panic mode over the domestic deceleration.
And that panic brings us directly to the core conflict. The bear case here is intelligent and it's grounded in cold, hard, competitive realities. The fear is that Lululemon is bleeding direct-to-consumer market share in the premium tier to younger, trendier upstarts. Looking at the data, from January 2025 to November 2025, Lululemon's DTC market share fell from 30% down to 24%. In that exact same window, Alo Yoga surged from 8% to 14%, completely capturing the fashion-focused athleisure crowd. Meanwhile, Vuori held a steady 5%, successfully defending its coastal California aesthetic. Lululemon's leadership actually had to admit that their product assortment became way too predictable in lounge and social categories, totally missing the opportunity to set new styling trends. This competitive pressure collided head-on with macroeconomic headwinds, resulting in a really painful quarter for profitability. While revenue actually beat expectations slightly, coming in at $2.47 billion, the bottom line took a serious hit. Diluted earnings per share plummeted 35%, dropping from $2.60 in Q1 of fiscal 2025 down to $1.69 in Q1 of fiscal 2026. A massive driver of this margin compression was an increase in U.S. import tariffs following the removal of the de minimis exemption. That alone dragged gross margins down by 280 basis points. They also saw SG&A deleverage as they spent heavily on legal and advisory expenses related to a proxy contest. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed.
So the crucial point is how management responded to this intense domestic pressure. They slashed their full-year fiscal 2026 revenue guidance down to a range of $11.0 billion to $11.15 billion, which implies flat to negative growth year over year. They also cut their EPS guidance by about 9%. But the major catalyst to watch here is the leadership transition meant to fix this exact problem. Former Nike executive Heidi O'Neill takes over as CEO on September 8, 2026. She brings 26 years of experience running Nike's direct-to-consumer and women's activewear divisions. Her absolute mandate? Execute a critical product refresh that increases new styling in their assortment from 23% to 35% to win back that lost market share.
When we synthesize all of this data into a qualitative scorecard, Lululemon scores a blended 6.7 out of 10. The story this tells is of a highly profitable but highly transitional business. On the strong side, their financial health is a 9 out of 10 because of that fortress balance sheet, and their historical track record of long-term wealth creation is a solid 8. But the weak spots are glaring. Market position is a 5 entirely because of the market share loss to Alo Yoga. Analyst sentiment sits at a dismal 4, with 29 out of 34 analysts holding neutral wait-and-see ratings. And management alignment is a 5, reflecting the recent executive turnover and near-term execution risks.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's look at how this valuation could actually play out over the next 5 years. Before we break down the numbers, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. These models use the current share price of $119.03 as the baseline and project out to year 5, which would be fiscal 2030.
Let's meticulously walk through the operational assumptions driving these numbers. In our base case, which we give a 55% probability, Heidi O'Neill's team successfully stabilizes the North American operations. Revenue grows at a moderate 6% annually, reaching $13.9 billion in year 5. Net margins normalize at 15.5%, and active share buybacks reduce the share count down to 102 million. That gives us an EPS of $21.25. If the market assigns a conservative 15x multiple, which is still half of its historical average, the implied price is roughly $318, representing an annualized return of nearly 22%. Now, in the high case, which carries a 20% probability, the product refresh is a massive hit, and China mainland growth stays above 20%. Revenue hits $16.3 billion, margins expand to 17.5%, and with a 20x multiple, the price targets $601. But we have to look closely at the low case, a 25% probability. Here, Lululemon structurally stagnates. They fail to win back share from Alo and Vuori, tariffs permanently crush gross margins to 11%, and revenue barely grows to $11.4 billion. The market slaps an 8.5x multiple on it, dragging the price down to $99. When you probability weight all 3 of these scenarios together, you get an estimated 5-year target price of $320.35.
That asymmetric recovery profile looks compelling, but we must treat the risk analysis very seriously. What would fundamentally break this thesis? First, if we see persistent America's comparable sales declining beyond fiscal 2026, it means the brand has structurally lost its appeal, not just suffered a temporary trend mismatch. Second, if that incredible 20+% growth in China mainland slows down to the single digits, Lululemon loses its primary international growth engine. Third, keep a very close eye on the gross margin. Management guided for a 160 basis point decline this year. If tariffs and promotional discounting cause gross margins to collapse under 50%, the premium pricing power is totally gone. And finally, if DTC market share continues to slip below that 24% floor to competitors like Vuori and Alo Yoga, the terminal value of this business shrinks dramatically.
Which brings us to the ultimate question for anyone looking at Lululemon today. Is this stretch completely snapping? Or is this simply a painful but necessary strategic reset? Right now, the market is pricing this stock as if the brand is permanently impaired, basically ignoring the fact that it is still a highly profitable enterprise with massive international traction.
Let's recap the bottom line and resolve that curiosity gap we opened with. First, the valuation disconnect is very real. Trading at a 9.2x PE is a historic discount for a company with zero debt and a 34% return on equity. The market is pricing in peak fear. Second, the economic engine remains intact. Yes, North America is struggling, but 20% revenue growth in China and a massive 7.1% free cash flow yield provide a powerful offset that funds massive share buybacks. Third, the catalyst is clear. Everything hinges on incoming CEO Heidi O'Neill. Watch the launch and sell-through of that 35% new styling assortment this September. If she stabilizes domestic traffic, that 9x multiple simply will not last.
If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.